Liquidity appears in many different areas of the market, and understanding where it forms can determine whether you win or lose a trade. One of the most common places where liquidity gathers is around supply and demand zones. In this class, I'm going to show you an advanced liquidity-based trading strategy designed to help you minimize losses, increase accuracy, improve your win rate, and ultimately become a more consistent trader. Now, before we move to the advanced part, let's make sure we're on the same page about what liquidity actually means. In trading terms, liquidity refers to orders in the market, typically stop-loss orders, buy stops, and sell stops. There are two major forms of liquidity that we'll focus on in this strategy: equal highs and equal lows, which essentially represent support and resistance levels, along with ascending and descending trend lines. Retail traders are often taught that when a market reaches a resistance level, it's a signal to sell. For example, after the second touch on resistance, that zone becomes a good selling level. Naturally, these traders will place their stop losses just above resistance, assuming the market will reject that area and move lower without breaking above it. But here's where things get interesting. If we know that many traders are selling at resistance, we can also assume that many stop-loss orders are sitting just above the equal highs. On top of that, we have breakout traders waiting to buy once the market breaks above that same resistance. They'll use the breakout as a retest level to buy from. So above that resistance level, we now have a cluster of buy orders, both from stop losses and from buy stops. And remember, a stop loss in a sell trade is technically a buy order, because when you close a short position, you're buying back what you sold, usually at a higher price. This means that above this resistance area, we have a large pool of buy-side liquidity. Now imagine you're an institutional trader, a bank, hedge fund, or any large player working with millions of dollars. If you try to sell a large position directly below this resistance, your order size will push the market down, giving you a worse average price with every execution. In short, your own selling would move the market against you. To solve this problem, large traders wait for liquidity to form above the highs. When the market pushes up and triggers all those buy orders, a flood of buying enters the market. This sudden burst of buy-side activity provides the liquidity big players need to fill their massive sell positions without moving price too early. As a result, the market creates what's known as a liquidity sweep or false breakout. Price breaks above resistance, hits all the stop losses, triggers the breakout buys, and then sharply reverses downward once the institutional sell orders fill. Retail traders who sold early get stopped out, breakout traders get trapped, and large players profit as the market drops. The same principle applies to equal lows. When price forms a support level, retail traders buy from that floor, placing their stop losses just below it. Those stop losses become sell orders, creating a pocket of sell-side liquidity beneath the level and setting up the exact same kind of trap, only in the opposite direction. Now, if you think from the perspective of a large institutional buyer, a bank or hedge fund, this pocket of sell liquidity is actually an opportunity. When the market dips into that area, all those automatic sell orders are triggered, flooding the market with selling pressure. That means there's now an abundance of liquidity for big institutions to buy into without pushing the price too early. Once their large buy orders are filled, price typically reverses and rallies upward, leaving retail traders wondering why the market bounced right after hitting their stops. So while retail traders are taught to buy support and sell resistance, the harsh reality is that this common approach has a major flaw. The true market movers, institutional participants, rarely enter at those obvious levels. Instead, they wait for price to move slightly beyond them where all the trapped orders sit.
That's why buying from equal lows and selling from equal highs often leads to failure, because those zones are magnets for liquidity grabs, not safe entry points. The same concept applies when we look at trend lines. After 2 touches on a trend line, retail traders expect the third touch to hold, so they start buying each retest of an ascending trend line, placing their stops just below it. But this again creates a pool of liquidity beneath that line, like countless stop losses from buyers, while breakout traders wait just below with sell stop orders, ready to short the market if the trend line breaks. What usually happens is not a clean bounce or break and retest. Instead, the market dips below the trend line first, sweeping all that liquidity before reversing back up. The result? Both buyers and sellers get stopped out, while larger players quietly enter in the opposite direction. The exact same idea applies to descending trend lines, just in reverse.
That's the foundational understanding of how liquidity behaves. Now, let's move into a more advanced approach, where we combine these liquidity concepts with supply and demand zones. Liquidity, market structure, and supply-demand imbalances all work together to shape price action, what many traders refer to as smart money concepts. But to trade effectively using this approach, we must always consider where liquidity is positioned around our supply and demand areas. For example, let's focus on a supply zone, an area we expect price to react from and move lower once it returns. In a perfect world, this would be a simple sell from the zone setup, but in reality, we must pay close attention to whether liquidity, like equal highs or trend line touches, exists around that zone. If price returns to the supply zone and forms equal highs or a double top, it may look like a strong rejection, but this can actually be a trap. What often happens is price induces sellers into the market by showing a reaction from the zone, only to push slightly higher and take out those equal highs before making the true downward move. This is what we call an inducement. The market lures traders into a position too early, clears out their stops above the highs, and then moves in the intended direction. So if you were to sell inside a supply zone without accounting for that liquidity above, your trade might look perfect at first until the market spikes up, takes your stop, and only then drops exactly as you predicted. In reality, however, the market doesn't always follow the straightforward scenario we hope for. Instead of immediately dropping from the supply zone, price might make one more push higher, sweeping liquidity before the real move occurs. But things can get even trickier when we're dealing with multiple supply zones, which is quite common in real market structure. For instance, imagine there's another imbalance leading into a higher supply zone about the one we're currently analyzing. If we put too much trust in the initial double top or the apparent resistance reaction, we might fall into a trap. Even if price shows weakness and starts to pull back, we still face the same liquidity problem. The liquidity sitting just above the equal highs remains untouched, making it highly likely that the market will reach for it. And when that happens, two outcomes are possible. 1, price may simply sweep the equal highs and reverse. Or 2, it might continue climbing into the next higher supply zone where even larger liquidity pools exist. This is why it's crucial not only to analyze what's happening inside the immediate zone, but also to understand the larger context, the zones and imbalances that price might be attracted to before making a meaningful move. So, how do we protect ourselves from getting stopped out both inside the first supply zone and within the broader context? The answer lies in a simple yet powerful entry concept called standard confirmation. Now, this isn't a new idea, it's simply a structural shift that helps us confirm when true control in the market has changed from buyers to sellers, or vice versa. By waiting for this confirmation, we avoid jumping in too early and greatly increase our win probability. Here's how it works. A standard confirmation occurs when the market transitions from a series of higher highs and higher lows, an uptrend, to making a lower low, signaling that selling pressure has taken control. After that shift, we look for a retracement into the newly formed lower high to execute our sell. That lower low is key. It represents a clear change in control from buying to selling. Once it's established, any pullback that follows offers a high probability entry point to join the new trend direction. Now, let's apply this concept to our earlier example with equal highs. In that scenario, we never saw a clean break of structure or a definitive shift in control. Price merely created a liquidity area and began moving within a small range, but without showing that decisive lower low. This suggests that before a valid entry presents itself, the market is likely to push higher, take out the equal highs, and then form that structural break we've been waiting for. If instead, price had swept the highs and then formed a meaningful lower low, that would have confirmed the shift in trend. From there, we could look to sell on the pullback, aligning both the short-term reversal and the broader bearish market direction. This combination, high and low time frame alignment, is what gives us a high probability trade setup. In contrast, when we see equal highs forming but no break of structure, what we're really seeing is a liquidity magnet, a level the market is likely to reach before turning. That's why waiting for that structural shift is so important. Once liquidity above the highs has been cleared and the trend shows a clear change in direction, the pullback offers the safest and most logical entry. This approach also becomes especially useful when multiple supply zones exist. Instead of guessing which zone will hold, we let the market confirm the shift for us. Often, what looks like a perfect sell zone at first might only create a small downward move before price runs higher to sweep liquidity and tap into the next supply level. Waiting for confirmation prevents us from getting caught in that premature entry. Now, with your understanding of liquidity, you can already see why you would have avoided selling too early. You know that when price is sitting just below a high probability liquidity area, the market is naturally attracted to it. Selling in that zone, before liquidity has been cleared, often leads to unnecessary losses. Instead, once the liquidity above is taken out, the smarter move is to wait for the standard confirmation we just discussed. Let's bring this concept to life with a real market example. Here we're looking at Euro CHF on the 5-minute time frame. Remember, this concept works across all time frames because it's based on the universal logic of supply and demand. At first glance, we can see that the market has recently shifted to the upside after retesting a demand zone and then breaking into a new high. To understand how to apply confirmation here, let's analyze the structure step by step. We had a clear impulse move upward, followed by several potential demand zones within the same range. Specifically, there are 3 main zones worth noting: a minor demand zone at the start of the move, another mid-range zone, and a deeper extreme demand zone at the base of the move. This one being the most important as it represents the last point before a major displacement upward. Now, when deciding where to buy, our goal is to choose the right demand zone, the one that aligns with confirmation and avoids premature entries. The first zone didn't provide any confirmation. Price simply continued lower, showing there was still imbalance beneath, a sign the market hadn't finished seeking liquidity. The second zone also failed to hold, again due to unresolved imbalance below. Only after reaching the final extreme demand zone did the market give us what we were waiting for, a clear structural shift. Here's how it looked. Price made a high, then a low, then a lower high, and a new lower low, maintaining a bearish structure. Then, when price broke above that previous high, marked as BOS or breakup structure, we finally had confirmation that control had shifted from sellers to buyers. This break validated a change in trend, giving us the green light to start looking for buy setups from fresh demand zones within that new bullish structure. The first potential entry would come on the pullback to one of those new demand zones, a higher probability entry that aligns both structure and liquidity. From here, we'd expect the market to create a new impulse leg and push into higher highs. Now that we've identified 2 potential demand zones, one higher and one lower, we need to decide which of them provides the better buying opportunity. It's important to note that both zones contain imbalances, which means price could easily be drawn to either area. The question then becomes, how do we know which zone to trust? This is where the inducement theory we discussed earlier comes into play. Our first step is to watch for confirmation inside each zone. Allowing the market to play out a bit further, we can see something important start to form, a change in trend. Price creates a new low and then begins to shift upward. The move eventually expanded into new highs, validating the entire setup. And that right there is the core concept, using a structured entry model to avoid inducement traps and stopouts, allowing you to trade from the highest probability zones. These principles aren't just theory, they've produced consistent results. Watch the next video. It's going to build directly on this concept. Thanks for watching, and I'll see you in the next one.